Hello and welcome to the Weekend Investing Daily Byte. Today is 20th of April, end of the week again. We have another short week where we have a long holiday on Friday, Saturday, and Sunday. And the market was as dull as it could be in the last four sessions. This entire week actually has been dull and drab, coming on the back of very good gains in the previous eight sessions. You can see here the Nifty chart, which is clearly showing you that the market is not willing to go down. In fact, the Monday's candle that you see there, the large red candle, the next 3 days, Tuesday, Wednesday, and today, Thursday, we've not even breached Monday's low. So all 3 days are inside candles of this Monday candle. And Monday's high and low will be very, very important in the very short term for this market direction. It seems like unless there is an external trigger, we will start to gradually inch up. And once we take out previous this current week's high, we will then seek higher ground. That is the likely setup that I can see basis this chart here. Today's movement, you can see the big hits were at Divi's lab in the pharma space. Cipla, Dr. Reddy's, Sun Pharma also hit a bit. Levers down 1.5%, Britannia down almost a percent. Infosys continues to go down almost a percent there, and some odd hits here and there. Tata Motors and NTPC, along with Bharti Airtel and SBI in the green. HDFC Life, IndusInd Bank, Tech Mahindra, Adani Ports were some of the Asian Paints were some of the other gainers in the green. So kind of a mixed bag, but nothing alarming as such. We've had a good correction in the last four sessions, and I think the market is ready for a next leg up. In terms of the sectoral overview, as we see every day, again, besides the pharma sector and some hits on the real estate, metals, and FMCG, mostly to do with corrective and profit taking on these sectors. Other than that, other sectors were pretty much flat or mildly green or mildly red. So, neither here nor there kind of a situation on most of the sectors. IT, of course, remaining the weakest uh, sector over the last 1 week, over the last 1 month, excuse me, and one of the weakest over the last 3 months also, with metals and energy also doing a double digit loss over 3 months. Mid cap stocks, the mid cap index looking very stable. There is hardly any down movement, just it went up and it went off sideways for the last two sessions. So it looks good from a relative strength perspective. Small cap index also, again, although it is showing three red candles, but just one close before below the previous close marginally. Other than that, the close has been up on almost on a daily basis for now almost 12 sessions or maybe even 13 sessions now. So this is quite a good run up, and maybe the market is waiting for some cue to really go for the next leg up. And I think that cue could be the dollar index that I have been waiting for since many days. Even on Nifty Bank, you can see the market has broken out of the trend line, out of this neckline here, and still just very small range of consolidation on the inside bar of this Monday candle. So really ready to go further up as soon as the market gives a green signal. This is one Mazagon stock. Doc was one stock that I was looking for in terms of stock of the day, where there's a good formation and possibly a continuation of this long trend that we had earlier last year. That may have, the flag pattern may have been built out, and we are now, going to create another long leg. It seems here. So this is the chart that I was talking about, the US dollar index. Uh, it failed to break down at 101 this 4 or 5 days back, but still it is in that vicinity. So I'm still expecting this to come down and break down of this neckline, and that will possibly give a very good fillip to the uh, equity markets in the emerging markets and to precious metals also. So this is something that I wanted to discuss. I tweeted about this also. That is Nifty hiding the truth of the market. So Nifty is only 4-5% down from the top. We went to a top of 18,800. We are now at 17,700. So hardly 5-6% from all-time highs is where Nifty is. But just look at where the rest of the market is. So I've done this categorization over two sets of data. The first set of data is all stocks which today have a market cap of 1,000 crores and above. So that eliminates a lot of nano caps, a lot of the not so important stocks. And in this cohort of 994 stocks, there are only 123 stocks which are within 10% of all time high. So, what Nifty is telling us that the market is within 6% of all time high. I'm saying even if I assume about 10% is a Nifty, even then, only 12 to 13% of stocks are within 10% of all time high. 232 or nearly 23% stocks are more than 10% lower, but up till 25% lower. And nearly 35% stocks are more than 25% lower, but up to 50% lower. And a big number, almost 29% stocks are below 50% from all time high. So while Nifty paints a very nice picture about how the Indian market is, but in reality the real portfolios and people who invest in non-Nifty stocks also, they would be seeing the impact of this kind of a the broader market being down much more than what Nifty is portraying. uh, and if I look at all the Nifty component, all the NSE components, I'm sorry, 2,240 stocks, if I consider, which are listed on NSE, a remarkable almost 30% stocks are below 50% from their all-time high. Now, I'm not saying that these are losses for people. They could be sitting, people could still be in profit because they may have bought it much lower than these levels also. But what I'm saying is, from an all-time high, whatever they had reached in the last few years, uh, we are down 50% for more than 30% of stocks. Another almost, I would say, 45 to 50% of stocks are between 10% and 50%. So, a huge number of stocks. Again, I mean, if I come back to the within 10% range, that is again about 12 to 13% only. So, whether we see 1,000 crore market cap or we see the entire NSE uh, uh, cohort, about 12 to 13% stocks are within 10% of all-time highs, and 87% stocks are below that, of which almost 30% stocks are below the 50% mark. So the idea being that if you were able to avoid at least these 30% of stocks which are down 50% or more, you would be doing much better than the average market portfolio, I would say. So the idea is that your strategy should be such that you don't have stocks which go into deep losses, or if they do tend to go towards those deep losses, you are able to get out and ride new winners and not be stuck with the stocks that can really harm your portfolio over a longer period. Another insight which I wanted to share, sources from Refinitiv NYSE, is that the holding period of stocks in years uh, has gone down dramatically. And you can see that After the 1929 Great Depression, the holding period went up till 1960. So people were obviously, once the Great Recession was stuck, the holding period of stock actually went up because stocks had gone down 90%, 95% in that period. And it took tens of years for those stocks to come back. So holding period was going up at that point of time. And since 1960, 65, the holding period of stocks in years has been dramatically reducing. In 1990, it was merely 2.5 years, and in the mid 2010s, it was about 1.5 year, and now it has shrunk to even below 1 year. So this is the way the world has moved, where nobody wants to hold stocks for a long period of time, and there are reasons for that. It is not that everybody's gotten into trading and they are enjoying option selling, and hence nobody wants to hold stocks. It is because the world has changed to some extent, at least. Now, what has happened is that, while digitization and, high frequency trading and people moving towards a faster approach or a get rich quicker approach has made a difference. But another fact, and this is from Macro Alpha, another fact, however, remains that we are living in a world of disruption more than ever before. So while 20, 30, 40 years back there were companies that could hold their moat for 5 decades, 10 decades, that kind of brands, that kind of competitive entry barriers to those industries. Now those things are more or less gone. Capital is no more so difficult to get. Even other elements of entry barriers have really gone down. So the average company tenure itself is down. So if you see this chart from 1965, the average company lifespan, this is, and mind you, this is an average S&P 500 company. So these are the top companies, even from the US and global perspective. The average company's lifespan itself has gone from 30, 35 years to merely 15 to 17 years. So when the average company itself will not last more than 15, 17 years, then buy and hold for 50 years does not make sense. So with each technological and advancement and highly competitive nature of every industry, and the potential of disruption in every industry, this trend is continuously down. I'm told that this average age will come to about 10 or 12 years as per some McKinsey study. So when the lifespan of a corporation itself is on question, then your investment into that obviously will remain much lower in terms of the averages as to how long you will hold to it. And that is the kind of world that we live in, and we need to live with that. So I'm so sorry. So essentially, what are the metrics? 85 years is the median age of S&P top 10 company uh, in 2000, which has dropped to 33 years as of 2018. S&P average S&P 500 tenure by 2027, not so far away, 12 years only. Average age of a unicorn startup 6 years, 5 years valuation growth in post IPO. Let's leave that part aside. So McKinsey report of 2018 predicts that we will continue this path down, where average company's age will keep reducing and average hold period will also be reducing. So what is the sort of learning out of this is that you need to have a strategy which will take you out of harm's way in time, before the sectoral shifts will eat your portfolio life. So just to give you some example, I mean, sectors will shift very, very dramatically from year to year. So I'm just going from one year to the other year, and these are the different sectors. And you can see each year will have some unique sector outperform, Each year will have some unique sector underperform, and there is no sort of, you will not be able to outguess, which sector is going to go where in each of these years. It is just like a musical chair happening. For instance, let's see, PSU banks were down 30% in 2020. In 2021, they were up 41%, and in 2022, they are up 137%. Now, who could have predicted that? So, or metals in 2022 were up 101%, and previous year also they were up 64%, but in, let's say, 2019, they were down 7%, and 2020 they were down up 13%. So huge shifts of various sectors at various points. Very difficult to have any linearity of approach here. There are these other sectors I could go on very long with this, but let me cut this short. I'm already out of time. So our solution to all of this is momentum investing, because momentum investing essentially picks the trends that are needed to be invested in at any point of time. It will ride winners, it will lose the losers, it will select naturally the best sectors that needs to be invested in. Whether it was PSU banks in 22 or IT stocks in 21. So you check the laggards, and at their fade, and you ride with the winners. So essentially, it is a self-correcting, self-healing mechanism of riding the markets without having to worry about how the average company duration, how the average hold, how sectors are behaving, which sectors are doing better, which sectors are not doing better. All that get automatically accounted for in momentum investing. That's all the message that I have today. Thank you so much for watching this episode, and I'll see you in the next one. Bye.